If you're stressed about investing in the stock market in 2023, you should seriously consider investing in dividend ETFs. In the next 8 minutes, you're going to become a dividend ETF wizard and learn about my 3 favorite dividend ETFs that pay very safe dividend yields. Although investing in dividend ETFs won't get you crazy Tesla-style returns, you'll sleep better at night because you won't have nightmares about Elon Musk running around with a flamethrower, lighting your portfolio on fire, and seeing all of your returns burn to dust. Before I get into my 3 favorite dividend ETFs, I gotta bust 2 big dividend myths, and we've got to set the record straight. Myth number 1, dividends are boring and don't grow your money. The truth is that dividend-paying stocks have actually outperformed the S&P 500 over time. From 1972 to 2017, dividend-paying stocks returned about 9% per year, while the S&P 500 overall returned just under 8% per year. And actually, stocks that don't pay a dividend at all, on average, returned under 3% per year during that same time frame, which is way worse than the average dividend-paying stock return. Myth number 2, stocks that pay the highest dividend are best. The truth is that stocks with a very high dividend, like 10% or higher, is actually a warning sign that a company could be in trouble and the dividend is likely to get cut. In the same period we talked about before, 1972 to 2017, companies that cut their dividend or eliminated it actually averaged minus 0.35% per year, which is by far the worst performing category in that comparison. All right, myth number 2 segues right into covering my 3 favorite dividend ETFs to build a strong portfolio of safe dividend-paying ETFs with. I'm gonna order these from most common to least common, so you've probably heard about the first 2, but then the third one is one that I haven't heard anybody on YouTube talking about. While you're watching, drop your favorite ETF down in the comments and I'll take a look at it and I might even cover it in a future video. All right, for each of these, we're gonna cover the fund name, the expense ratio that you pay to be invested in the ETF, the dividend yield, the style or process of that ETF to select its dividend stocks, the top 10 stocks in the ETF, the average PE, performance over time, and then finally, dividend growth, because that is such an important metric. When you do 3s, do you do them like this or do you do them like this? I feel like I'm not really flexible enough to do them like this, so that's number 8. All right, so let's get to it. First of all, where am I getting these from? Well, I'm letting Morningstar actually kind of filter these. I'm only selecting from their Medalist ETFs, which are exchange-traded funds that they believe have what it takes to win in the long run. Okay, and number 1, and it's actually the top performing Medalist ETF that they have, and I've talked about it on this channel before, is the Schwab US Dividend Equity ETF, SCHD. It is a large cap value category. It gets a silver rating from Morningstar. And get this, over the last year, when a lot of these growth ETFs are down 29 and 30%, it's only down 3%. And then over the last 3 years, it's up 13% per year. And over the last 5 years, it's up almost 12% per year, which is actually strongly outperforming the rest of these funds. It is important to remember that past performance is no guarantee of future returns. So keep that in mind. All right, and this fund, first of all, it excludes REITs or real estate investment trusts, and it filters out stocks that have market caps smaller than 500 million or have not paid a dividend for at least the last 10 consecutive years. And then it ranks the stocks based on criteria that the fund has selected to pick its best dividend stocks. They look at 4 different metrics: cash flow to total debt, return on equity, yield, and 5-year dividend growth rate. And then it ranks stocks by the composite score, and essentially adds the best stocks to the portfolio. Okay, and as you can see, it is a large cap value fund. Now let's get into the price to earnings ratio and the dividend yield. The price to earnings ratio is a very reasonable 13.68, which is below the category average of 14. And the dividend yield is a very strong 3.62% right now. This fund is 21% invested in financial services stocks, 16% invested in industrials, 16% in technology, and almost 14% in consumer defensive stocks. It has 99 total positions with 40% of the assets in the top 10. I like that because it's not super concentrated in its top 10 stocks. And here are those top 10 stocks. They are ranging from 4.5% to 3.66% of the portfolio. You've got Broadcom, Verizon Communications, Cisco Systems, Merck, Lockheed Martin, Texas Instruments, PepsiCo, Coca-Cola, Home Depot, and BlackRock. All right, next up we have the Vanguard Dividend Appreciation ETF, VIG. I'm sure you've heard of this one too. It's a large blend fund, gets a gold rating from Morningstar. The 1-year return is actually a little bit worse than SCHD, minus 9%. Over 3 years, it's up 8.8% per year. And then over the last 5 years, it's up a very strong 10.35%. Okay, and this fund tracks the S&P US Dividend Growers Index that holds stocks with a history of increasing dividends for at least 10 consecutive years, again, dividend growth. And then the securities must pass a minimum market cap and trading volume requirements. That's so there's no funny business going on with crazy movements in the stocks just due to volume to be eligible for inclusion. Then the index ranks eligible stocks by their indicated annual yield and then filters out the highest ranking quartile to avoid riskier bets. So it actually tries to get away from higher yielding stocks, but it lowers the threshold for current holdings to the top 15% to limit turnover. Okay, and then this fund moves a little bit more towards in between large cap value and growth. So what you're going to notice is it has a price to earnings ratio that's higher than SCHD of 18.35. And then SCHD has a dividend yield of over 3%. VIG's dividend yield is 2.07%. It's invested in a lot of the same sectors as SCHD, but actually has a higher allocation to healthcare at 15%. It has 289 holdings and 29% of the assets in the top 10 positions, which is actually lower than the 40% from SCHD. And the top 10 stocks range from 3.78% of the portfolio down to 1.91%. You have United Health Group, Johnson & Johnson, Microsoft, JP Morgan, Visa, Procter & Gamble, the Home Depot, MasterCard, Coca-Cola, and Broadcom. I really like this one because it focuses on that dividend growth and it has more exposure to healthcare, which is a pretty recession resilient sector. All right, and the last one. This is the one that I think you probably haven't heard about. A lot of people haven't heard about. I don't hear it talked about much. The Spider Russell 1000 Yield Focused ETF. The ticker is ONEY. It is a mid-cap value. So right there you can see we're moving down into mid-cap to get a little bit exposure to mid-cap. Still gets a silver rating from Morningstar, and it's actually held up really well over the last year, down only 3.5%. While it's up almost 11% over the last 3 years and 9.58% per year over the last 5 years. All right, this index looks for Russell 1000 stocks, and then it uses the stocks weights to favor those with high dividend yields, attractive valuations, strong quality traits, and smaller market caps. The value, quality, and small size factors have historically been tied to market-beating returns, so their consideration should aid performance. This is why I like this one mixed with those other two large cap. You get a little bit of smaller cap exposure, which can give you a little bit better growth sometimes. Yield is the focus, and it's weighted twice as heavily as the other factors, so they're looking for higher yields in these. And this is a nice mix with those other two funds that aren't as focused on high yield and more focused on dividend growth. All right, and you can see we were up in the large cap value and blend, and now we're down in the mid cap value category on Morningstar. You can see we have an even lower price to earnings ratio of 12.17, and this is the highest, or it's close to the highest between this and SCHD, dividend yield of 3.49%. You get pretty broad exposure across different sectors, with the highest being financial services, 15% in consumer cyclical, and then 10% in industrials and 9% in real estate. Okay, there's 298 holdings, and this one is even less concentrated. Only 14% of the fund is in the top 10 holdings. And so this is where you're gonna see some different companies, not all the popular companies that we've heard of in the S&P 500. You have Phillips 66, Gilead, HP, Valero, Marathon, T. Rowe Price Group, Linden Basel Industries, Dow, OneOak, and Cummins. So you get a lot of energy and kind of utility type exposure in this fund that you're not getting as much of in the other two. All right, let's cover the expense ratios, and we'll cover these expense ratios side by side. We have SCHD at a 0.06 expense ratio. Same thing for VIG, and ONEY is still a very reasonable but higher 0.2%. So if we look at total return of these three funds, and this incorporates the dividend, over the last 5 years, they're all pretty strong. You have SCHD at 71.67% total return, ONEY at 64.24%, and then VIG at 60%. All very reasonable, especially when you consider these are pretty conservative dividend-paying ETFs. If we zoom out even more over the last 10 years, this is where SCHD really starts to outperform. Now, it's important to note SCHD and VIG go back to 2013. ONEY only goes to 2015. But SCHD is up 233%, VIG is up 192%, and ONEY is up 135%. And honestly, over time, you're gonna see these things kind of just go back and forth depending on which one is in favor. That's why I really like the combination of building a safe dividend ETF portfolio using all three of these. You could balance them equally, you could do whatever you want. And if you do that, you may not get the most returns in the world, Tesla returns, but I think you're gonna sleep better at night. You're gonna enjoy investing. You're gonna be able to focus on doing more things in your life that you enjoy and not stressing over the stock market. That's what a portfolio like this does for an investor that wants to build wealth over time and dollar cost average into the market over time and grow a very nice dividend portfolio. If you made it to the end, that means you are a dividend loving investing nerd just like me. You might be a big fan of this channel. I just want to say I appreciate you so much. I appreciate you watching. It's hard to stand out on YouTube. The way that you can help me and be invested and help this channel grow is by liking the video. That helps the YouTube algorithm know that people want to see it, and it'll help more people find it. And then subscribing to the channel, which helps the channel grow, and it helps me stand out above some of that other noise and other crazy videos that are out there on YouTube to give this quality investing content. Thanks so much for your help, and I'll see you in the next video.